Welcome to all of you. My name is Kamal Manocha. I represent PMS AIF World. So today we have a very special guest, one of the youngest fund managers I have ever interviewed, Mr. Anirudh Garg. Before I give the context to Anirudh, I would like to tell you that just imagine if there was a way to actually control greed and fear, and then make unbiased investment decisions. It would have been actually a wonderful way of investing. Anirudh claims that he has actually worked for more than a decade to build a strategy which kind of works in an unbiased way in such decision making, and hence it is interesting, and I am also kind of kind of wanting to believe in his claim after we go through this detailed webinar with Anirudh. He comes, he's managing director and part of the founding team at INVasset, managed a very well-known PMS, and brings with him 15 years of experience. Going by his qualification, he is a chartered accountant and has also done a master's in investment management from United Kingdom. So more we would want to know over this webinar when we hear from Anirudh Garg. In the first part of this detailed discussion, Anirudh has prepared a presentation where he would want to give us a lot of generic perspectives about the equity markets, and his thought process of approaching this difficult yet simple, I would say, industry where he is kind of wanting to create his career. Let's hear it out from him, and then in the second half we'll do Q&A. Over to you, Anirudh, for the first part, and warm welcome to you. Many good wishes to you for this presentation. Go ahead.
Thank you. Thank you so much, Kamal. It's indeed a privilege. It's my first presentation at PMS AIF World, and I'm really excited about it. Thanks to all the audience for joining us on a Friday evening. And I'm really looking forward that if I could add some value. A small disclaimer here that whatever we say in this presentation, whatever the aspects of equity markets we discuss, they're not for solicitation and only to share our thought process with you so that it may add some value to your investing career. Uh, could you please have my presentation here? So we are INVasset PMS. My name is Anirudh Garg. I am a chartered accountant by education and have been into investing since 2007. So you can imagine I've seen everything from the 2008 bear run to the 2020 financial crisis and the huge rally we had in between. INVasset was conceptualized, guys, just with one thought in mind that let's eliminate human bias and the corresponding feelings of greed and fear. The only way we understood we could do it was through scientific and data-driven approach. So we conceptualized INVasset IAD, which is our algorithm, and we take proud in owning it. And we have been implementing it since 2016 in the markets and have backtested it since 1990 on a day-by-day basis. We are a SEBI-registered portfolio managed service provider. Uh, INVasset, the concept on which INVasset's algorithm was based was conceptualized by my father, Mr. Rajneesh Garg. He has been into the market since 30 years, full-time investing experience, started in 1992. He himself is a chartered accountant. We are a 20 plus member team based on two stations, Gurgaon and Mumbai. Uh, our mission is to create alpha for the clients. 1.5 to 2x is what we aim for over a 3-year cycle. And we also aim at the highest level of customer service. As I told you, our founder, I would like to start by acknowledging him, Mr. Rajneesh Garg, my father. He's a chartered accountant and a company secretary with 30 years of experience. His road to fame is he started with a meager capital of 10 lakhs, and today he's managing a prop desk of around 150 crore plus at an annual CAGR of 24% plus. So first of all, let us focus on why India. So if we are investors, why do we want to invest in India? This is some data that we had collected. In this, if you see, we have taken the top 25 economies of the world, all the way from United States to Ireland. So what we collected was a data of the working population under 20. How many people under 20 are there? So here is the data. and we've collected the median age, monthly wages that are there, number of hours they're willing to work per week, and how good a democracy the country is. And then we have rated them on ranking basis and given them points out of 25. So if you see a collection here, what we are seeing that India is scoring the highest at 107 points, while China is at 84. The next competitors to India are developing economies like Mexico and Indonesia. So what does this data mean? This data is very simple. It means that India has a young population which is available at a very reasonable working rate and are willing to work for longer hours. Apart from that, India is a democracy unlike China, where if you grow your business, it is not upon the government to take you down. So you get my point? A working population willing to work hard in a democratic country, available at reasonable rates. That is why we feel that India will be the center spot of the global economy for the next at least 15 years. So we have a democracy, we have a demography, as I told you. Finally, we have a stable government which has not only 5 years, I believe, a 10 years vision. The Indian entrepreneur spirit we all know is amazing. Young population accustomed to long working hours. Government has finally set in and started supporting the Indian entrepreneur. We can see a lot of intention from government side in terms of corporate rate cuts, a lot of PLI schemes coming in, a lot of initiatives like Make in India and Atmanirbhar Bharat coming in. And one of the most amazing revolutions, guys, of our times was the Geo revolution, I would call it. Geo came in and our broadband population increased many folds. They say a 10% increase in the broadband allocation rises the GDP by 1.5%. So it may be a generalization, but I do believe that it will help a lot when India has to compete with already established giants like China. When all this was set, then comes COVID. And India has, I believe, handled COVID very well. And COVID would actually help India, would actually act as a catalyst for India to grow. China plus one, people now don't want to be entirely dependent upon China or even Europe in terms of a lot of production was there in Ukraine. So China plus one, Europe plus one, COVID pandemic. These are all turning out as catalysts for countries like India, which are willing to grow. Government has introduced many schemes like the DFC, Bharat Mala, Sagar Mala, Gati Shakti plans. I believe all this taken together is the right recipe for a country which has to grow. Okay, so we know that, okay, India as an economy is the right place. What about the Indian stock market? So this is a very interesting data. Here you see that India, the greens are where the skewness is less towards a particular sector, and reds are where the skewness is more towards a particular sector. So you see India is the least skewed sector in terms of when it comes to sectoral distribution. Uh, what does this mean? This means that Indian stock market, in terms of its large cap funds, its large cap companies, is not in like inclined towards a particular sector and is more and has a component of everything from consumer discretionary to staples to energy to industrials to technology to materials, everything from old economy to new economy. And the same trend is there in the small cap index also. So we have taken this data from the MSCI indexes, and we were helped by White Oak in this getting this data. So, as you can see, the most unskewed economy of all, India. What does this mean? So, what we believe at INVasset is that world typically rotates between two types of runs. So, one is the old economy run, and the other is the new economy run. So, what happens in an old economy run? In an old economy run, inflation is always rising, while in a new economy run, inflation is falling. An old economy run focuses on value, while the new economy run, it focuses on quality. Commodity pricing during an old economy run are always rising, while the commodity prices in a new economy run are falling or are rather sideways. GDP growth, there is tremendous GDP growth that happens during an old economy run because it is fueled by credit. As we can see, credit is at a decadal high, this is an old economy run which is going on. GDP growth is low when a new economy run comes. So corporate plus government capex, as we see, is at its maximum. It's rising. While in a new economy run, there is no capex or less capex, I would say. Who are the type of very funny thing I would like to discuss here is who are the type of managers who make money in an old economy run? DIIs, I believe, make more money in an old economy run because they are the people who will buy those sectors to which an old economy run caters to. While FIIs are those people which will make money in a new economy run. So if you have to distinguish between two types of countries, I would say in an old economy run, countries like India will benefit, while in an new economy run, countries like USA would benefit. So what are the sectors that will define an old economy run? Say PSUs, commodities, capex, real estate, commodity producers, and commercial banks. While in an a new economy run, all those new age sectors like IT, pharma, FMCG, consumer durables, any type of consumers of commodities like wires and all, and retail banks do better. If I want to tell you in terms of where these runs have happened in India, so from 1983 to 1992, India saw an old economy run, and same from 2001 to 2008. And our take at INVasset is that currently, after 2020, we are seeing a old economy run. While from 93 to 2000, up to the dot-com bubble, we had a new economy run in India and the world, and 2009 to 2020, which is very recently finished, we believe that India also saw a new economy run where all those ITs, Asian Paints, and HDFC banks, and rather Bajaj Finances and such companies did tremendously well. So what does this mean? This means that India has a multifaceted stock market, which gives us an opportunity to generate alpha by finding the new leaders in both types of runs. So before we tell you how we construct our portfolio, I would like to discuss what are the various investment styles that are available in the market. So value-based investing. Value-based investors are those which have a knack of finding value in a company. They see that a company is trading below its fair value, they buy it and hold it until they feel that it is above fair value or has become a little expensive. For example, the guru of investing, the father of investing, Benjamin Graham, was a value based investor. Special situation or change based investing, one of the most popular the investing styles that are there in the market. These people, what they do is they try to find out the earning visibility for the next 2 to 5 years based on some recent changes, to try to find out the who the leaders would be in the next 2 to 3 years, and accordingly accordingly make their portfolios. Quality focused investing. So a lot of since we have just finished I would say just finished a new economy run, which is a quality focused run. So all those investors which buy companies which have amazing managements, have moats, have a first mover advantage, they do not need tailwinds. These are those people, these are those companies that do not need tailwinds and just keep on growing from their free cash flow and return on capital employed and return on investing in equities. Amazing. And the last but not the least, there's another investing that happens is that, which I would say is pension fund or fund protection investing, where the person or the fund manager's decision is that, okay, I want to make money, but my primary focus is not to lose money. You get it? So what we have done, how do we construct your portfolio? Our algorithm incorporates all the four styles of investing: value based investing, special situation, quality focused, and pension fund investing. We call our algorithm or the strategy, whatever you want to call, the IIT shifter. What we do in the IIT shifter is IIT shifter has four stages based on these four styles of investing. First is the deep discount sale. Okay, so deep discount sale is when the markets are oversold, when the markets are in a capitulation zone. For example, something that they were in March 2020 or June 2020, June 2022. So what do we do here? We believe that we cannot find companies that have value, or if we can find, we cannot sit them with them for a longer period of time. So what we do, we only buy value when there is value in the entire market. What we do, we buy those blue chips which are available at a discount due to some abnormal movement in the markets. For example, we were buying Tata Motors, Tata Steel back in March 2020. I can very clearly remember because they were available at amazing discounts. Tata Motor was available at 85% discount from its highs. Okay. So if India has to make cars, Tata Motors is one of those leaders which will not go out of business because of COVID or things like that. Okay. Second is trendsetters. Trendsetters is where majority part of our algorithm works. Now, from oversold markets, when the markets they go to a reasonably priced zone, all these factors where on how to determine the markets are oversold or how they're reasonably priced or how they're expensive, this is all predefined in our algorithm. We are not looking to time the market. What we are looking is, if we get a particular zone, we are happy with it. If we do not get it, does not matter. So we are not timing the markets. But if we get some particular indicators, if we get all the check boxes right, we are ready to take decisions according to that. Okay, so markets are reasonably priced. What we do here is we change to special situation or change based investing. Here our algorithm works in such a way where we try to look in for tailwinds or growth for the next 2 to 3 years. What are the factors that have happened in the market that will lead to the growth in the next 2 to 3 years? Quality focused investing. Now, when we believe that the markets are expensive, we name the stage the shining stars. We come into those quality focused investing. Now that the markets are expensive, let's go to some companies which are self sufficient and do not need any kind of tailwinds. Okay, so companies that have inherent advantages like superior management, moats, monopolies, or are even disruptors. Somebody like a Bajaj Finance comes in every few years. Okay, and the last but not the least, when we feel that the markets are exuberant. Okay, so again mentioning, we are not looking for these phases; they come automatically. So when we feel that okay, all the tick boxes for markets exuberancy is there, now I'm an investor. Particularly, I don't want to just always be invested in the stock market and blindly follow the market when they are expensive. So what we do is we reduce the beta further. So suppose I had a Bajaj Finance in shining stars, I would now actually go to a HDFC Bank where I know that growth may be a little less, but if the market falls, my portfolio would not be mattered that much. So with this entire process, what happens is a lot of small case investors they face a problem that where to sell a stock. So as you can imagine, we are actually moving from one stock to the other, and in the same time, we do not need to time our exit out of a stock. So I'll give you an example. So we were in deep discount sale from March 2020 to November 2020, when the Nifty was from Nifty moved from 8,600 to 13,000. So I would take the examples of financials or banks, which I think cater to all types of markets. So we bought actually in our portfolio IndusInd Bank at 350 rupees, around 350 rupees, and we were able to shift from IndusInd Bank at 850 rupees. Why did we buy IndusInd Bank at 350 rupees, and why we sold it at 850 rupees? First of all, IndusInd Bank, being a part of the Nifty, we consider it as a blue chip, and it was the most beaten down stock in March 2020. Okay, and then in trendsetters, now we are looking for changes. So what has changed in the market? So if we look at the last 5 7 years, what was changed in the market was a lot of new laws had come in. The NCLT laws had come in. Public sector banks were cleaning their books like anything, and they were set for a big run going forward. So our algorithm points focus to buy State Bank of India. State Bank of India, we bought in November 2020, and till May 2021, we were holding it from 250 to 420 rupees. Okay, and as the markets, so in May 2021 only, so our algorithm is not 100% perfect where it says that we have found the very top of the market. So in May 2020, it started saying that markets are now expensive. Okay, and it's time to move on from State Bank of India. So we moved from State Bank of India to the quality name, Bajaj Finance. Bajaj Finance being the leader of retail loans, top management, high return on capital employed, does the business in a way that nobody else can. So we shifted from Bajaj Finance, and particularly what we focus on Shining Stars is we are looking for somewhat growth here also. Markets, they've become expensive, but markets have a tendency to remain expensive for a very long period of time. We have seen that in the past. So even if from here I do not get my fourth stage and I'm holding my Bajaj Finance and the market crashes, I'm okay with it. I'm holding my Bajaj Finance, doesn't matter, it has to grow. And finally, if I get the fourth stage, which we got in September 2021, where they said that the markets are exuberant and the risk reward ratio of staying in the markets is not amazing, let's go to some security or some positions where you don't have to lose much. So we shifted from HDFC Bank. So we bought HDFC Bank at 1595, around 1600 levels, and it came to 1400 levels. So in safety shells also there comes a fall, but it's not as much as I would get in holding a IndusInd Bank, which we were holding earlier. So you get the entire point is shifting from one to another and reducing beta by the time. So this is our first, I would say, advice for all of you, and I think our contribution that as the markets become expensive, try to reduce beta so that when the market falls or a correction comes, you are not caught with the wrong stocks. So I'll explain these stages with one slide each so that you get a better understanding of what we do. Deep discount sale. So deep discount sale is based on the fact that corrections happen. Corrections, are evident part of equity markets, and developing economies like India, we see two type of corrections. So one is a bull market correction, and one is a bear market correction. A bull market correction, it happens every 2 to 3 years, and a bear market correction, it happens. So in my career, if I look at a bear market correction, only two have happened. So one was in 2008 global financial crisis, and one was during the 2020 COVID pandemic. So what are the characteristics of these falls? So a fall of 15% in the bull market correction, and 35% plus in the bear market correction. So what do we buy? What does our algorithm buy in a bull market correction? It buys the leaders of the current run. So for example, if in this run a correction comes, like it came in June 2020, so what we were buying there? We were buying, since we believe it is an old economy run, so we were buying everything from capital goods to public sector banks to maybe commercial banks like ICICI. While in a bear market correction which happened in 2020, we were buying blue chips which were available at historically low valuations. As I told you, Tata Motors, Tata Steel, whatever is available at extremely low valuations, maximum discount, those are the companies we buy. Blue chips, to recognize blue chips, I think the easiest way we know is to find selected from the companies that are there in Sensex and Nifty, because it takes a lot of quality in terms of whatever work you do to remain in Sensex and Nifty, the top 50 companies of India, in such a competitive world. At INVasset, we welcome the corrections. Two reasons. One is they gave us an option of top-ups, which we till June we had not got for the past 1.5 year, and it helps us to add a little bit of alpha just by sectoral rotation. For example, autos were doing nice while maybe metals were not doing nice. So shift a little bit of portion from one preferable sector to the other preferable sector until a mean is received. The trendsetters. So this is how we I think we set a little bit different from other managers. When we know that okay, the markets are now reached a point where the markets are not neither cheap nor expensive, they are at a median zone. What are those companies that will create alpha in the next 2 to 3 years? So we believe that every bull run has a new leader, either in terms of sector, company, or group. And what we do is to just strive to find this leader. How do we find these leaders? Spot the recent changes or tailwinds that have happened and try to predict the earnings visibility for the next 2 to 5 years. So how does the IID algo work to spot the trendsetters? Very, very easy. If you guys remember how we spotted India in from the top 25 economies, a few factors, 7, 8 factors we analyzed, and then we said that okay, India is a good country to analyze. This is what we do in trendsetters, nothing fancy, just uh, a data-driven approach with the help of Python, where a lot of data can be managed together. We just try to find out what are those companies which will be the leaders for the next 2 to 3 years. So we analyzed 1500 plus companies in that on 150 parameters. So like I told you in sheet one where we were discussing various economies, we discussed 25 economies. Here we take up 1500 companies. We discussed 5, 7 parameters. Now we are analyzing 150 plus parameters. So yeah, this is what we have worked really hard on. We call it the RC square model, where it's called a relative change rewarding criteria, which means that if good is happening for a company, so suppose a government policy comes which is good for, say, Dixon Technologies. So Dixon Technologies would get more points. While if a government policy comes which is against a against a chemical company, so more points would be deducted. So relative change rewarding criteria, and this is what we believe, that if there is a fundamental good which is happening for a company, ultimately it will play out in the stock market. It is just that we need to have the data together so that we can analyze those companies going forward. What we do is form a percentile tracking system. We've analyzed all the companies, rewarded points on various bases, and then a percentile ranking system, like how we do for say for a IM selection, that okay, the top 1 percentile would be selected. So what we do is try the entire process. What it does is it gives us top 100 companies to research. Okay, so it is not that we buy companies which come here. We get 100 companies that will research. Now what happens is we have broken out of the shackles of those top 100 200 names which are prevalent in the market and everybody is researching. The new names, the new leaders, who are going to research them? This is why we built the IDALGO and the RC square model. So top 25 companies that are selected are then rejected or selected based on the reverse rejection criteria. What does this mean? Is that okay? Suppose there comes a company like BCG, no, not BCG, maybe something like a Adani or something, where a lot of things are moving towards Adani, but when I try to analyze it, I feel that okay, I'm not comfortable with these companies, or my research person says that okay, there is a problem X with this company. So you have to reject those companies and not select from the top 100 companies. So if we, out of the top 100, I reject company 2, 3, and 4, and then I'll take the top 25 companies based on we make proper research reports. We have a very good fund house which goes into the details after those companies have been selected. Giving you a few examples on what are the various factors that we weigh companies on. uh, Changes in management or capital restructuring. Old management, a management which was not very effective goes out, a new management comes in, something like United Spirits may Diageo coming in, and we straight away knew that okay, now the focus would be on reducing the debt as their policy is around the world. Or capital restructuring happens in a company. Foreign or domestic government policy changes. A lot of factor, a lot of performance of the company depend upon how the policies of the government they change. Suppose China banned the production of chemicals, and the vacuum that was created had to be filled, because the world is not going to go down on consumption of chemicals. It's actually increasing by the day. So somebody had to fill up those. So India was the next best destination. Or Modi government said that a particular sizes TVs could not be imported, had to have to be manufactured in-house in the country. So of course Dixon Technology scored really up. Or opportunities that are arise out of a global event. Every global event, whatever it be, it may sound a little bit harsh, but every global event creates an opportunity in the stock market. Stock market is not very emotional. For example, COVID-19 came, there was a lot of opportunity that arose for work from home, pharmaceuticals, and things like that. Similarly, when the war in Europe broke, so a lot of special steel companies and bearing companies and I would say a lot of fertilizers companies, they started getting traction because there is an opportunity or a vacuum that has been created in the market. So things like that. So point-based system is on things like that. So interest rate cycle, as I told you, a lot of implications that it is a new economy or an old economy run. How is the inflation gonna behave? How has it behaved in the last 5 7 years? Things like that. And we keep a lot of data on how the inventories of commodities and everything are around the world, and based on that we give our what do you call we give our input to the algorithm, and then it makes a selection. And also, I would like to acknowledge here is that 20% of our points are also given to momentum, where some companies that we may miss out of our criteria, we have only 150 plus parameters, around 170 parameters that we are analyzing on, but and they are ever increasing. But we tend to miss a few companies which are not covered under our criteria. So 20% of the weightage we give to momentum, so that if we are missing something, we may be able to analyze it through the momentum points. Shining stars, as I told you, when the markets become a little bit expensive, now we don't want to be in those companies which are moving with the tailwinds. Now we want to be on a safer side, because we believe that capital is very, very sacred, and losing capital is the biggest crime that you can commit in the market. So we focus to shining stars. Shining stars are the leaders. They are the best in what they do, and one major point between shining stars is that growth is a very important factor. So we believe that we are looking for stars, shining stars, and not just stars. A lot of companies are there which are diffusing stars. We are not looking for those companies here, because markets have become expensive, but as I told you, they tend to remain expensive for a very, very long period of time. What are the qualities of shining stars? Prudent and efficient management, high ROCE, good dividend policies, good buyback policies, related party transactions are negligible, the promoters are the best and have excelled in whatever the businesses they have done, market leaders in terms of I think being in a monopoly, as my very dear friend Amit says, is the best place you can be. We all know these companies: baby cereals, Nestle, Paints, Asian Paints, cigarettes is ITC, adhesives is Pidilite, all these wonderful, beautiful companies. But we buy these companies only when the markets have become expensive. We do not hold it for the period when the market itself is not very expensive. A lot of these companies have moats. For example, product. Coca-Cola in India, we have their counterparts like Nestle, HUL, network. Amazon in India, we have those amazing network by India Mart Intermesh. Low cost retail. In America, we have Walmart. In India, we have D-Mart. So all these companies, and sometimes if we are very lucky, we get something that we really, really like, is disruptors, first movers in any business segment, and they change how that business was done in the past. For example, it comes with an idea. A company from Pune starts very, very small and says retail loans are safer. And पैसे तो कॉर्पोरेट्स मारते हैं, रिटेल्स में तो लोन सेफर ही है. The Indian middle class is very, very afraid of getting his name scotched. So retail loans are safer. Bajaj Finance came up with this idea, and you know how the biggest wealth creator of the decade, I suppose. Free broking for all. Zerodha came with that concept and broke all the traditional brokers that were out there. Food delivery made easy. Zomato came with this idea, and though listed at a very expensive valuation, but I believe a wonderful company to be in for a long period of time. So in shining stars, out of growth, stability, and degrowth and valuations, what we do is we like growth, which normally comes expensive. So if you see here, we are not willing to let growth go, but we are also, growth will never come cheap, that is for sure. and we are not looking for exuberant valuations also. So we did not subscribe to any of those Paytms or Zomatos or Nykas because we believe that they are very, very expensive. But if I have to buy a Bajaj Finance, I would happily do it because it is expensive, but there is growth to support it. It doesn't matter. Okay. And last but not the least, our final stage, the safety shells. The only where we believe that the markets have now become exuberant, we have a lot of factors. So it is not my call or anybody else's call to, in our fund to call that okay, the markets are now expensive. A lot of formulae have been set to give us a understanding of to tick all the check boxes that okay, so you have say 25 algorithms set in, and out of the 25, 21 or 20 have checked the box. So we feel that the markets are exuberant now. Uh, Here, our focus shifts totally from growth, which was in shining stars, to safe conservation. Now we want to conserve our capital. 9th of September 2021, we moved out of the stocks and were sitting on. Actually, we were sitting on very low beta stocks like Cipla, HDFC, Dr. Reddy's, and things like that. And along with them, we had also hedged our portfolios by writing the calls of these stocks, and we were okay. We were like, okay, for the next 1 year, we till the markets fall or the time correction happens or the price corrections happen, we are not comfortable with the market valuations and would not let our hard-earned money that we have earned in the markets go away. So what we do is we reduce the beta further, as I told you. Non-correlated assets. Okay, this also depends. Everything is based on an algorithm. Everything is based on a few factors, which if tick, then only we take the particular decision. Non-correlated sectors we buy like gold, bonds. So this time we bought bonds. We were not very comfortable with gold also, because though gold started rising for them, but our system did not allow it. Liquid or arbitrage funds. Uh, if we get special situations, so we have a desk entirely for special situations. So whenever we get a special situations opportunity, we take it. Special situations is like when it happens through mergers, demergers, and stuff like that, where free money is available in the market. And we also, as I told you, hedge. So hedging is basically either through Nifty, which I don't prefer that much, but we buy stocks and then start writing calls where uh, it becomes a 2% per month process. And even if the market falls, you don't tend to lose much. So we did it in 2020 also. We did it in from 9th September, 9th of September 2021 also. So just whenever we have ended our phases, this is PMS AIF World data. We have performed. We have tend to be in the best PMSs in India. So when we ended the trendsetters phase in June 2021, we were the top performing fund in India with a 1 year return of 127%. Uh, when we ended the Shining Star phase in September 2021, we were among the top, we were the third. Similarly, when we ended the deep discount phase in August 2022, we were also among the top three of our comparisons in India. This is it, guys. Thank you. I think I've taken a lot of time, and session Kamal is open. These are a few disclaimers. I would like you to read these disclaimers going forward. Would love to share the presentation.
I
Yeah,
think the presentation was very interesting. So I would like to go through this presentation again. But there are a
sure.
lot of questions that are coming to my mind where you said there is a new economy, old economy, and currently the bull run which is going on is pertaining to the old economy businesses, and I can see that. So, what are your views? If I want to understand, you are a budding fund manager. What's your sectoral view going forward from here onwards? To begin with, if I want to understand, a few things. So the first question that comes to my mind that from here onwards, if I have to understand, what's the sectoral view?
Okay, Kamal, see, if we look at the macros, Government of India has allocated 19% of its expenses towards capex, and the private sector capex, which was absent for say last 10 years, has also started to pick up. This year, I am talking about macros, and based on that, what our algorithm is selecting. We are very bullish on sectors which are related to capex. Uh, Anything which is related to capex, whether it is metals or whether it is, I think, capital goods or maybe railways or defense. We think that uh, going 3 to 4 years down the line, India is in dire need of all these things, especially defense and railway infrastructure. And with this stable government in the center and the vision it has, we believe these will be the sectors that should excel or generate alpha in the next 2 to 3 years. Apart from that, Kamal, we also believe that whatever bad had to be done with public sector banks, quality public sector banks is already done with, and a lot of value creation will be there when they come to their mean.
Sure. So as per your algorithms and your ideology, do you see markets currently fairly valued or undervalued, or they are still kind of looking expensive?
No, we do not feel that the markets are expensive. We feel that Indian markets have just started their second phase of bull run in the current cycle, and going forward, though we do not like to give any predictions about the market, but we feel that the next 1 and 1.5 year we should see a considerable growth in Indian markets, with Nifty reaching 25K levels plus.
I must say. Right. What is the view on the current capex cycle going on?
I think an amazing capex cycle is set in. With the capex cycle, it is very difficult to get it started. But once it starts, it has it. Like it's like a train. It leaves the station slowly, but once it is left, it really gains momentum. One of our very senior managers said it, and I believe that he has depicted the capex cycle in absolute way. It is just the train has just left the station, and the momentum that has to be picked would be great. We would not have even imagined this 2 years before that Indian capex cycle could be this strong.
But though capex cycle is looking strong, what are the views within that? So if you have to talk about few themes in terms of businesses that look to be interesting to be added, or you are looking, how are you guys as a portfolio managers taking advantage of this capex cycle in terms of your portfolio management?
So we are taking. So what we look for is visibility of earnings for the next 2 to 3 years in terms of, and in the old economy run, we are looking for value. So when we look at value, if you look at defense in India, they say that defense is really shot up. I do not believe that. I think it's just started. It's just sprouted out, and the tree is still there to be made. Indian defense for a country like India of 150 billion plus population, set at such a sensitive zone. We are importing all our defense equipments from abroad. Defense actually rests on the intention of the government, and this government has made it very clear that we want everything to be produced in India. We want things to be atmanirbhar. As we see how proactive they are in terms of speaking against the world and then going to Russia and getting the discounts on crude, their intention is very clear that we want India to be atmanirbhar. So when India to be Atmanirbhar and you're getting Indian naval defense with such a big coastline, one of the biggest coastlines in the world, with such a big coastline, you get Indian naval defense companies at 11 PE at 5,000 crores. I think a lot of value is still there.
Sure. So, if we say, discuss few stocks in your portfolio, maybe, few top holdings, couple of top holdings you want to discuss in terms of the type of business models or the sectors they come from, that will kind of give us, some context of your conviction with regards to your viewpoints. And obviously, I want to kind of, verify that with your whatever you're kind of talking about. So you talk about private banks, you talk about capex cycle, you're bullish upon, right? So what are the top 4 or 5 stocks, or maybe any stocks from these areas that we have talked about? Are you holding them in your portfolio?
Yes, of course. So in terms of defense, though we don't, okay. So in terms of defense, we hold all the defense companies that are there in India. We are very bullish on defense in India. We are very bullish on the railway capex. So we believe that a lot of work will come to companies like Aircon and RVNL and things like that. And I am very also very particularly bullish on the large public sector banks. Something like a Canara Bank, I think, should do very, very well. Their valuations, they've been disregarded by the markets and market veterans. Of course, in the new economy run, where all those bad loans and everything had come, these banks, they had to underperform. But ultimately, when all the mess is cleared up, we believe that for the public sector banks, again, I believe the bigger ones, for the bigger ones, a lot of catching up in terms of valuation has to be there. And even we are okay with companies like ICICI Bank and Axis Bank in particular.
In auto sector?
Auto sector, we believe that okay, auto sector we believe is a sector of both the runs. People have to get change their cars. People, but little bit why ought we do not take a bet on the auto sector is that um, it is a consumer of commodities, and commodities now are at a very, very high rate. So as the prices of commodities increase, the pressure on the auto sector is immense. And with government getting so many policies in terms of EVs or hydrogen and CNG, diesel, petrol, I think the auto sector we believe is a little bit confused right now, that what to do in such a phase where we do not have a clarity on how the next 10 years would be. So we believe that the auto sector for the next 10 years would be going through a lot of shaking, like a lot of manthan, and then the best companies would emerge out of it. So it lags a little bit on the points system, where we do not have a clarity from government in terms of tailwinds for the auto sector.
Sure. So mostly, investors in general, they track prices more, but fund managers track earnings more, and that's, very big difference.
Mhm,
And within that now, over last say 18 months,
mhm,
what's your, I would say, objective evaluation? Like if we were talk about bigger picture, China, for example, in terms of prices have fallen a lot. We have seen around 40% correction, and then from there recoveries also happened around 20%. Likewise, in US, we have seen, massive correction, especially in Nasdaq.
mhm,
India has actually, in terms of frontline, not seen much correction because some of the old economy businesses, as you are saying, have been supportive. But the new economy businesses have seen correction. In
mhm,
terms of price, we're first focusing on the price part, right?
mhm.
What's your view? Is it supported now by some, I would say, growth in earnings also, and hence the cycle is again going to change, or you see, India has actually corrected lesser than other markets. Is this conveying something about maybe India leading future bull run, or India lagging behind in the future because it's not corrected much? If you were to kind of comprehend this entire thing in terms of price and earning, maybe in a more elaborate way, that will be a good idea.
Yeah, sure. So first of all, there's a very nice question, Kamal. So first of all, India, if it is at a higher valuation or has not fallen much, that is due to a reason. First of all, those reason was if we compare it to the US. So we'll compare it to US and China. If we compare it to the US, Indian IT technology companies, they saw exuberance, but not as exuberant as the case was in case of what Nasdaq companies did. Something like what a Tesla did, or something like all those new age IT did, and something like what a Zoom Communications did. All these companies went haywire. So in India, there are some such companies which listed at exuberant valuations, something like a Zomato, Paytm, Nika. Okay, but they do not constitute our index, right? They are not a part of the Nifty. In America, they are a little bit. So America has tend to underperform, or Nasdaq particularly has fallen so much because there was a lot of exuberance in Nasdaq. While if we compare it with China, so it may be a bigger and bolder statement, but I think we should compare apples with apples and not apples with oranges. Why? In China, the management quotient is zero. You have a company, you have a person like Jack Ma. If the same person would have been in India, would have been one of the most respected people. But in China, anybody who becomes big, or any company that becomes big because of their aristocratic rule, because of their communist rule, they believe that it is a threat to the national party, and they tend to destroy it. Chemical companies, people were setting up chemical companies in China in 2013. The government says that okay, we are now a developed nation and we do not want to focus on chemicals now. So shut off all the chemical companies within a year. So I think such, and you cannot go against the government to the court. So where there is no certainty about the future, where the outer bracket is missing, what I think India is not comparable with China. China, I believe, is going through that same Japan phase which had happened. It will correct and then again go back 20, 30, 40% and then correct again because that confidence of investing, that confidence of investing has been lost in China. US we believe still would be okay, but only the valuations in US have to be a little bit better, especially in Nasdaq. Otherwise, I think the components of Dow are not that bad. Dow should be doing fine, we believe.
In that context, if we talk about India in terms of price to earning at present, fundamentally, what's your view?
So okay, we do not focus much on price to earning. We focus on the components of the. If we have to look at Nifty, though we do not own any of the Nifty stocks right now, maybe a couple of them only, but like ICICI Bank and all. But what we believe is that India, the index is distributed into three parts. First part is financials, which in India, by God's grace, by RBI's grace, with our conservative nature, the banks are very, very comfortable. They are, with the lending business, they have a good stick on their head. So they tend to do well. They are not like the US banks who can take any sectors and then destroy their capital. Okay. And then the other part is, I believe, IT. The second part is IT, which is a growing theme, okay, and not at very exuberant valuations, okay. So when there is a recession happening in the US, they may tend to underperform a bit for a smaller period of time, but again we believe that they will pick up pace and should not be big underperformance in terms of market performance. And third part comes to our old economy sector, which I said that India is a multifaceted stock market, and a lot of value addition in terms of earnings would be happening in this part. So all your ABBs and all your L&Ts and all your Bales and all your wonderful companies that we have here, and all your PSU banks and financials, I think a little bit dragged by IT, but supported by financials and accelerated by old economy. India should do preferably well. Such a combination is not available anywhere in the world, I believe.
To the end, last 5 minutes. So I would want to ask you a few quick more questions. Maybe you can
Yeah,
give
sure.
short answers.
Yeah.
Do you have PSU banks in your portfolio?
Yes, a few.
Okay, but are you preferring PSU banks more over private banks, given the value comfort there and your approach being value focused?
Absolutely. So we believe that for for the next 2 to 3 years, value should be the focus. And PSU banks, they were bad. I'm telling you, they were bad, and we also believe that they were bad. But it is a thing of the past now. New economy run has finished, and the old economy run has started. The books of the PSU banks have been cleaned up. Whatever the companies which were lagging, which were not paying up the PSU banks, have started doing well. I know it from personal fact. Say, for example, something like a Godavari Power. Okay, the company is now doing extremely well, and it's paying its PSU banks back. So all those probable provisions that PSU banks had done, they are not now done away with, and government has supported them when they're weak, and now it is the time that PSU bank should make considerable money. I was checking it today only. State Bank of India has 45 lakh crores of borrowings, is available at 5 lakh crores of valuation, while HDFC Bank is available. Though I'm not saying that the quality of HDFC Bank and quality of State Bank of India is the same, but see the valuation difference there, that 45 lakhs is available at 5 lakh crores and 18 lakhs is available at 9 lakh crores. So a little bit of catching has to be done, but that little bit of catching would actually end up a lot for the PSU banks. A lot of alpha is there.
Right. Stocks like ITC, would you consider them new economy stocks or old economy stocks?
Okay, so ITC we believe are new economy stocks, but in new economy stocks, sometimes what happens is, so I like ITC right now. Though we do not have it, but I like it. You like something, but it's not necessary that your algorithm would allow to buy it. We believe that valuation comfort is there in terms of ITC, and also in terms of ownership in the market. we believe that ITC is a better stock to hold than Hindustan Lever or Asian Paints.
Sure. So one question that comes to my mind, and I saw somebody asking this question in chat also. What's the fundamental difference between quant-based investing and algo-based investing?
They are the same.
Okay,
It's just where you call it quant, I call it algo. It's just that the numbers take the decision rather than fund manager taking the decision.
sure. So what has been your experience otherwise, being in this industry, you are managing around, I would say 60 crores of assets into PMS, right? So obviously, reaching on to 60 crores of assets would have given you some learning. What has
Yeah,
been your
so
experience, over,
okay,
say,
so I've been actively managed. I was the active manager of my before coming into PMS. I was active manager of my prop desk also from 2016. So my with the quant with the algo, what I feel is that it has provided me a lot of comfort. My mind, like any other person's mind, is still biased कि PSU banks नहीं चलेंगे. But when I look at the data, when I look at the quant taking the decision, I am able to overcome that feeling of fear and not succumb to feelings of greed by buying something like a Asian Paints. You get my point? So it becomes very, very easy for the fund manager to take a decision because it is the data that is taking the decision, not the fund manager himself.
right. What's the view on any upcoming new sector like we have seen specialty chemicals as a sector which came up from bottom and
Mhm,
actually created maximum wealth over last 5 years?
mhm.
Any such small sector that you feel or your quant is throwing? Is it possible for quant to throw such futuristic ideas also in long term?
Yes, absolutely, absolutely. We had owned. So I still remember back in 2016 when the first specialty chemical company came to our focus. So it was a completely new sector, and we had to do a lot of research on how are they different from other chemical companies and इतनी छोटी companies में wealth creation हो भी सकती है कि नहीं हो सकती है. So we have been owning specialty chemical companies for a long period of time, and we have wrote them together. And now we feel that they've become a little bit expensive. Or what we believe is that stock markets are relative. Okay, specialty companies are doing good. Maybe Asian Paints would all also continue to do good, but where is the value? Where is more growth? So stock markets are, I believe, relative, and they tend to focus on those companies which will grow for the next 2 to 3 years better than other companies. So that is why we have a one specialty chemical company also, but not that much now.
Sure. What's the view on commodities, I would say based businesses like sugar industries and all? Do you invest in such businesses?
I think the train is not just left the station. Also, it's the engine is just started. For the next 2 to 3 years, a lot of wealth creation would be happening in these companies.
So you mean to say you're bullish?
Yes, very bullish. Yes.
Any stock, any idea that you want to talk about to maybe put
We
the
we
context?
are we like Hindalco a lot. I think it's the only Vikalp that is there in India now after Vedanta exiting. So we believe that this company is a long way to go.
Anirudh, I think it has been really pleasure conversing with you. A lot of,
Same.
I would say, practical discussion that we have done, which investors are always looking for beyond theoretical discussions. Many fund managers talk about a lot of stories, but you have actually, talked about a lot of real practical stuff, be it, defensives, be it, some of these upcoming sectors, and then obviously quant throwing all these ideas is a learning that even I have had. I never believed that. It would be interesting to maybe converse more. And thank you everyone for logging in today on this interesting webinar. And we'll be coming again, with more similar interesting webinars soon. We have a kind of a line of a lot of panel discussions and similar webinars lined up for our upcoming Crystal Gazing Summit 2023, which is planned for 10th and 11th of February. And Anirudh is also one of the panelists there. So I this is my kind of uh, announcement to all of you who are listening to us in this webinar to do visit our website, PMS AIF World. You may book an appointment with us to discuss further about INVasset, or you want to listen and hear Anirudh Garg again, do join us for Crystal Gazing Summit 2023, where we have Anirudh as well as 30 more such speakers, all thought leaders from the industry, talking on 15 topics, which we have very carefully kind of selected, and those topics are realistic questions that most investors today have on their minds. And I am inviting all of you because I understand that more you learn, more you earn. So thank you once again, and looking forward for more such webinars. Thank you.
Thank you, Kamal. Thank you so much. And thank you, everybody, for sparing this 1 hour for me on a Friday evening. Have a good weekend.
Pleasure is ours, Anirudh.
Thank you. Thank you.